This is a special podcast presentation from 700WLW.com. This is Casey Boland on Demand.
Hi, Casey Boland's joining me. Casey's with Hanghold Capital Management, as you ought to know by now. Casey, how often should somebody have their 401k reviewed?
Well, I think if it's one of the 401k providers, that probably should be on an annual basis. And it's interesting when I look at many of the different 401k plans, there's a study that really aligned with what I've seen as well, and that so many 401k plans, they essentially have a lot of their own in-house funds. Oftentimes, they'll keep underperforming funds for a very long time. A recent experience for me in looking at somebody's 401k plan, there were 32 investment choices in the plan. 18 of these funds were target date style funds, which means they're very diversified. But, you know, within the 32 options, 24 were products of the 401k provider. I thought that's quite a bit.
Now is that average? Is that typical? You tell me.
Well, I think it is typical, unfortunately. You're looking at 8 other choices outside of, the in-house choices, and some of more reasonable options, but there's a bias too much to some of the in-house products. But, when you dig a little bit deeper, because 32 seems like a reasonable number, there are only 2 foreign mutual funds, and those 2 funds had a very similar investment strategy. So really, essentially meant I had 1 foreign fund or choice to have. There were 3 bond choices in the plan, and within those bond choices, 2 of the 3 funds had an annual return of about 1.2 to 1.3%, which really is like an enhanced money market fund. So the reality is there was 1 pure bond fund choice in the plan, and that's just too limited of options, in my opinion, both in the foreign side and the bond choices, and this is much the norm of what I see in many of the 401k plans.
So did this client take your advice?
They did. So they're over age 59 and a half, and we did what's called an in-service withdrawal, which allowed them to withdraw money out of their 401k plan and transfer it to an IRA, because at that stage, they have a significant amount of money in their plan. They can then build an IRA and have it really customized so it's going to be appropriate for their own circumstances. You may talk to your plan administrator, see if this plan option is available if you have limited choices. And again, this is a very common occurrence that I see.